The Fed has held, as expected. China has lowered interest rates to cushion its domestic economy from the Liberation Day tariff shock. Those lower rates in China have unleashed funds going into Hong Kong, putting upward pressure on its currency peg with the US dollar. And New Zealand jobs data was soft despite a better than expected unemployment rate. That's coming up in our 5 Things in 5 Minutes on Thursday, May the 8th. And then in part 2 of a deep dive interview about Australia's $4 trillion pension fund pool, ANZ senior rate strategist Jack Chambers explains how these funds are improving Australia's current account deficit.
Australia is not going to be Japan or Germany running massive, persistent, large current account surpluses. But it will shift away from where it was 10 or 20 or 30 years ago, where it had these large, persistent current account deficits.
But first, in 5 and 5 with ANZ, the US Federal Reserve's Open Markets Committee has just decided to hold its Fed funds rate in a range of 4.25% to 4.5%, as expected. Here's ANZ Head of G3 Economics, Brian Martin, talking from London this morning, right after the decision made at 4 a.m. Sydney-Melbourne time.
The Fed has acknowledged that economic uncertainty has risen and that the risks to it achieving its dual mandate on both employment and inflation have risen. That means that there's a greater risk that inflation might be higher than the target and not coming down to it as quickly as they had thought it might do, or indeed that the unemployment rate might rise higher than they had anticipated it will. And that's what they mean by greater risks to either side. I think that means that the Fed is going to remain extremely vigilant.
Brian says the market reaction has been relatively muted so far. As of 4:30 a.m. Sydney-Melbourne time, the 10-year US Treasury yield was down 4 basis points at 4.27%. Gold was down 1% at $3,390 an ounce. The S&P 500 up 0.2%, as was the US dollar index. The Aussie dollar down 0.4% at 64.66 US cents, while the Kiwi was down 0.5% at 59.79 US cents. West Texas Intermediate futures are down 2% at $58.14 US a barrel. Number 2, China has unveiled a package of looser monetary policy and fiscal and banking support for businesses as it grapples with the effects of 145% tariffs on its exports to the United States. The package included a cut in the reserve requirement ratio for banks and a cut in interest rates. Here's ANZ's chief economist for Greater China, Raymond Yung.
The policy package includes both the monetary policy easing and also some financial support to exporters, including supporting their exporter insurance and some other financial support. We know the impact of the Liberation Day has already been reviewed in some of the data. The new export order in April PMI fell to the lowest point since December 2020. It dropped by more than 4 percentage points in a month. And we also believe the job market conditions has worsened. The unemployment rate shooting up.
Number 3, officials from China and the United States will meet this weekend in Geneva for the first substantive trade talks. So the timing of the Chinese stimulus package was not coincidental, says Raymond.
They picked the timing right before the trade talk between China and the US officials in Switzerland this week. And we believe this is a carefully crafted timing. They try to do this and provide some of the buffer or policy buffer to support Chinese exporters before the trade talk. It seems to us that the Chinese government are prepared to have a protracted negotiation. They remain to hold a strong stance against the protectionism from the US.
Number 4, Raymond says this support package is having a spillover effect into Hong Kong.
In the first quarter, it seems to us that they want to extend the market sentiment in order to provide some support to domestic consumption because wealth effect is very important. So given the policy support, we also expect that the local onshore interest rate will be down. The overnight repo rate will be dropped by 10 to 20 basis points this month. With the onshore interest rate very low, we do expect a lot of the capital outflow to the Hong Kong market. So the Hong Kong dollar has reached the strongest allowable within the convertibility undertaking.
Number 5, New Zealand's unemployment rate was unchanged at 5.1% in the March quarter, which was better than ANZ Research's forecast for 5.3% and the Reserve Bank of New Zealand's forecast of 5.2%. But ANZ senior economist Miles Workman says the data was softer than it appeared at first glance.
For the Reserve Bank, obviously we've got a lower unemployment rate than they were forecasting, but at the same time, wage growth came in weaker than their forecasts. So if they are to calibrate what this might mean for domestic CPI inflation pressures, that's cost push wage pressures flowing through to consumer prices, they're likely to conclude that in fact parts of these data are a touch more dovish than they were expecting.
Miles Workman there. Now, in part 2 of our deep dive into Australia's $4 trillion compulsory private pension system, that's where 11.5% of everyone's wages are put into a pension fund, ANZ senior rate strategist Jack Chambers explains how these funds are improving Australia's current account deficit.
If you think about the current account, there's really two parts that matter. There's the trade balance, which has been positive for Australia, particularly for goods and services. We've been exporting more stuff to the rest of the world than importing, partly because of higher commodity prices and just higher volumes of commodity. Iron ore exports to China is the one that most people think about. What that's been offset by historically is the primary income balance, which is the other main part of the current account. That is essentially income that Australia earns from the rest of the world versus the income that we pay to the rest of the world. Historically, Australia pays quite a lot of income to the rest of the world, mostly through equity payments, and so dividends, and interest on debt. Because Australian mining companies, are largely owned by offshore investors, a lot of their dividend flows flow offshore. And also since about half of Australian government debt is owned by offshore investors, the coupon flows, the interest rates on the interest payments on that debt flows offshore. What's going to change is as super funds keep buying more and more offshore assets, fixed income and equities in particular, they will start to receive more income payments to them. You'll get more inbound income payments to Australia, which means over time we'd expect the current account to shift, maybe not always into a surplus, but into a structurally more balanced position. The way I think about it is Australia is not going to be Japan or Germany running massive, persistent, large current account surpluses, but it will shift away from where it was 10 or 20 or 30 years ago, where it had these large, persistent current account deficits.
And there has actually been a brief period when Australia was able to run current account surpluses. Can you tell us about that and where we are now?
Yeah, that happened in that sort of pandemic period, or really particularly after the Russian invasion of Ukraine. What happened was energy prices, so a lot of the things that Australia exports, spiked really high. And the initial reaction to that was the trade surplus increased a huge amount in value terms because the value of a lot of what Australia was exporting, the terms of trade, the cost of what we export versus the cost of what we import, increased quite a lot. And so that really put Australia quite unusually into a current account surplus. That has unwound. Those energy price shocks, and energy prices have fallen when it comes to things like the cost of liquefied natural gas have fallen. And so Australia is now back into a current account deficit. But it's nowhere near, it's not nearly as large as that deficit was 15 years ago.
And has all of these changes in capital flows and income flows shifted the currency at all in any substantial way, or should we look for it to do that?
So this is one of the interesting ones, and one where the directionality is not entirely clear. There's two ways of thinking about it. One way of thinking about it is when superannuation funds acquire offshore assets, they start with AUD and they sell AUD to acquire those assets. So that, at face value, should lead to a weaker Australian dollar. What that's somewhat offset by is when a country runs a large current account deficit, it has to, like I said, it has to attract offshore capital. You can attract offshore capital in a couple of ways. One is have a cheap currency. One is higher interest rates. Now that Australia doesn't run as large a current account deficit, the currency doesn't need to be as weak to attract that capital. So in some ways, the offsetting factor of superannuation funds selling AUD via offshore assets is that Australia is less beholden or doesn't need to attract as much offshore investment as was the case in the past.
Jack Chambers there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, May the 8th. Catch you tomorrow with more reaction and analysis to the Fed's decision and commentary going on as we speak. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.